You wake up one morning and your account doesn't work. Your card declines. Your banking app displays a message about temporary restrictions. Your funds are still there technically, but you cannot reach them. If the money is yours, how can access disappear? If ownership is real, why is it conditional? They do not need to empty your account to control it. They only need to lock you out. This is not a personal finance warning. It is about how modern banking architecture is built around conditional access. In a digitized financial system, control over money does not require physical seizure. It requires administrative authority. And that authority is embedded deeply into the structure of the monetary system itself. The modern bank account is not a vault. It is a liability. When you deposit money, the bank records a liability on its balance sheet. Your deposit is legally an unsecured claim against the institution. The bank owes you the funds, but the funds are not segregated in your name. They are pooled, lent, invested, and leveraged. This distinction rarely matters in normal conditions. In stress conditions, it becomes central. Access to deposits depends on the solvency and liquidity of the institution holding them. Solvency refers to long-term asset coverage. Liquidity refers to immediate cash availability. A bank can be solvent on paper and still restrict withdrawals if liquidity tightens. This is not theoretical. Throughout monetary history, access has been paused long before value disappeared. In 1933, banks across the United States closed during the National Bank holiday. Depositors could not withdraw funds for days. The currency did not collapse overnight. The banking system was stabilized, but access was suspended. In Argentina in 2001, withdrawal limits were imposed to prevent capital flight. Accounts remained, but daily access was restricted. The measure was described as temporary. Temporary measures often redefine permanence. The mechanism gap opens here. How can modern systems lock access without visible collapse? Digitization. Money today exists primarily as ledger entries. Transfers occur through centralized clearing systems. Payment networks are monitored continuously. Compliance frameworks require real-time screening for anti-money laundering, sanctions enforcement, and risk controls. These frameworks are presented as safeguards. They are safeguards. They are also control mechanisms. Banks have the authority to freeze accounts under suspicion of irregular activity. Algorithms flag transactions. Compliance departments review patterns. During review, access can be limited. This process is administrative. No court appearance is required in many cases. The account holder often learns about restrictions only after access fails. The asymmetry is quiet. The institution acts first. Explanation follows later. In times of systemic stress, authorities can impose broader controls. Capital controls restrict cross-border transfers. Withdrawal limits manage liquidity strain. Transaction thresholds prevent sudden outflows. These measures are rarely announced until necessary. By the time they are announced, the decision is already made. Most people assume that in stable economies, such tools are irrelevant. But stability is not defined by absence of tools. It is defined by their non-use. The tools remain embedded. The structure permits activation. During the financial crisis of 2008, several countries introduced emergency liquidity measures. Money market funds were guaranteed to prevent runs. Central banks opened extraordinary lending facilities. Retail depositors did not experience widespread lockouts in many advanced economies. But institutional access tightened rapidly in wholesale markets. Repo funding evaporated. Collateral requirements increased. Liquidity was rationed. The public rarely saw these restrictions directly. They were contained within financial plumbing. Containment masked fragility. When Cyprus faced a banking crisis in 2013, depositors experienced direct bail-ins. Large deposit accounts were partially converted into bank equity to recapitalize institutions. Deposits above insured limits absorbed losses. The legal framework existed before the crisis. Few depositors examined it. Late realization arrived with enforcement. Modern banking regulation increasingly incorporates bail-in mechanisms rather than bailouts. The rationale is to reduce taxpayer burden. Instead of governments rescuing banks with public funds, creditors and large depositors may bear losses. This policy shift changes the nature of deposit safety. Deposits are no longer implicitly guaranteed beyond formal insurance caps. Access remains conditional. Insurance caps vary by country. Amounts above those caps represent unsecured exposure. Few households track these distinctions closely. Illusion of safety persists. Digital payments amplify centralization. Cash usage declines. Online banking increases. Real-time payment networks integrate with identity verification systems. Convenience improves. Intermediation deepens. When payments depend on centralized platforms, access depends on compliance. Non-compliance, even temporary or algorithmically inferred, can interrupt flow. The interruption does not require insolvency. It requires suspicion. Suspicion can be procedural. In periods of geopolitical tension, sanctions regimes expand. Financial institutions are required to monitor and restrict transactions linked to sanctioned entities or jurisdictions. These obligations increase monitoring intensity. Increased monitoring increases false positives. False positives result in temporary freezes. Temporary freezes can disrupt livelihoods. The broader system remains stable. Individual access becomes uncertain. The consequence gap widens. If digital currencies issued by central banks become widespread, access architecture may centralize further. Central bank digital currencies would operate through programmable ledgers. Transactions could, in theory, include conditions. The technology allows for granular control. Whether such control is exercised depends on policy. The capacity, however, is structural. Capacity alters the meaning of ownership. Ownership without access is symbolic. The historical transition from cash to electronic money reduced physical bank-run risk. It also increased systemic visibility into transactions. Visibility enhances risk management. It also enhances intervention capability. In earlier eras, withdrawing physical currency limited institutional control. Today, most transactions require electronic clearing. Electronic clearing is interruptible. Interruptibility is a feature, not a flaw. It prevents panic from spreading uncontrollably. It also centralizes authority. During times of inflation or currency instability, governments have imposed withdrawal limits. This is to prevent rapid capital flight. The rationale is stability. Stability may require temporary restriction. Temporary restriction alters expectations. Expectations define trust. Trust in monetary systems relies on access reliability. If access is perceived as conditional, behavior changes. Depositors diversify institutions. Capital seeks mobility. Institutions respond with tighter controls. Control and mobility exist in tension. In economies with high debt levels, banking systems rely on stable deposit bases to fund lending. Sudden withdrawals force asset sales. Asset sales depress prices. Depressed prices weaken balance sheets. To prevent this spiral, authorities may act preemptively. Preemptive action may include restricting withdrawals. This can happen before panic spreads. Prevention is rational from a systemic perspective. From an individual perspective, it feels confiscatory. Institutional asymmetry emerges again. Institutions anticipate collective behavior. Individuals react to personal constraint. The legal language governing accounts often includes clauses permitting suspension for compliance, fraud prevention, or systemic risk. These clauses are standard. Few read them. The right to restrict exists contractually. The system does not need new laws to act. It needs only to invoke existing authority. When crises unfold, speed matters. Digital systems enable rapid response. Rapid response can include rapid restriction. The illusion of permanent access erodes quietly. Most of the time, nothing happens. Accounts function. Payments clear. Trust persists. But the structure has evolved. Money is no longer an object you hold. It is a permission you access. Permission can be paused. This is not a prediction of imminent lockouts. It is a recognition of capacity. Capacity shapes power. Power shapes stability. Stability prioritizes continuity. Continuity sometimes requires constraint. In sovereign debt crises, governments have occasionally restricted bank withdrawals to prevent capital flight and protect currency reserves. These measures are framed as emergency responses. They reveal structural hierarchy. Currency preservation outweighs individual liquidity. In such moments, the system does not collapse instantly. It compresses. Compression feels like suffocation to those inside it. But from a policy perspective, compression preserves order. Modern financial systems are interlinked globally. Cross-border flows depend on correspondent banking networks and central clearinghouses. Sanctions, regulatory compliance, and liquidity management intersect. An account freeze in one jurisdiction can cascade through payment chains. Interdependence increases efficiency. It also increases points of control. Few individuals map these chains. Late realization occurs only when a transaction fails unexpectedly. Even outside crisis conditions, algorithmic risk scoring can limit access. If an account's activity triggers automated flags, transactions may be declined. Appeals processes exist. They are slow. Time is leverage. Access delayed can be functionally equivalent to access denied. Credit lines can also be reduced without notice under risk reassessment. While not a direct freeze, reduced limits constrain purchasing power. Constraint alters behavior. Behavior affects economic flow. Flow sustains growth. Growth underpins debt servicing. Debt servicing maintains bank solvency. Solvency preserves monetary order. The chain is continuous. They can lock you out not because the system is collapsing, but because the system is designed to prioritize its own continuity. Continuity requires tools. Tools include restriction. Restriction is framed as protection. Protection for whom depends on position. The mechanism gap closes gradually. Bank accounts are contractual relationships within a leveraged system. Access is contingent on compliance, liquidity, and policy. Ownership is conditional. The consequence gap resolves quietly. As economies become more digitized and debt-dependent, access control becomes a primary lever of stability management. Not dramatic seizure, not overt confiscation. Conditional access. This recognition does not demand panic. It demands clarity. Money in the modern era is not merely stored value. It is mediated value. Mediation implies gatekeepers. Gatekeepers operate according to institutional incentives. Institutional incentives prioritize stability, solvency, and compliance. Individual liquidity is secondary. Most of the time, these priorities align. In stress, they diverge. When divergence occurs, access can narrow. Not because the system has failed, but because it is functioning as designed. And understanding that design changes how permanence is perceived. Access feels permanent. It is not. It is maintained. Maintained systems can be adjusted. Adjusted systems can restrict. Restriction does not always mean loss, but it reveals hierarchy. And hierarchy defines who moves first and who waits. They can lock you out. Not loudly, not dramatically, but structurally. And the structure has been in place for years.